Hey everybody, pop goes that VIX bubble. VIX rallied sharply when the market dropped 10%, but now as the market just dribbles up 5%, you can see that VIX is almost down to nothing. Well, 16 is pretty high for the last several years. But this VIX is going to go back down to below 10, and when it goes down below 10, I'm going to keep you posted because that's going to be a tremendous buying opportunity for VIX. Those of you who've been following my VIX recommendations know you just made a huge amount of money. Hey everybody, Courtney Smith here with our weekly TradeSmith. Let's get going.
And now, the moment you've been waiting for all week, Courtney Smith's weekly video newsletter, TradeSmith.
All right, let's take a look at what we got here. The most important thing, of course, is our disclaimer. S&P 500. Look at what's happening here. Purple predictors breaking out to new all-time highs, or in the last week it did that. The price action, not bad, not great yet, but we're seeing, for example, on Friday, a pretty strong close to the week, which is, I think, pretty good, combined with the accumulation that we're seeing the smart money make, which is shown by the purple predictor. So this chart remains quite bullish in my humble opinion. All right, Dow Jones, let's look in the upper right-hand corner. Still more selling pressure than buying pressure, but notice how the buying pressure is slowly creeping higher, but the selling pressure, which is the red line there, is coming down pretty sharply. And that's why the market is just churning at the current levels. It's not popping up, it's not dropping down, but we're starting to equalize that buying and selling pressure. Nasdaq, not as bullish. Notice this, the price action's been not as bullish. The purple predictor is not as bullish as we saw with the Dow and the S&P. In other words, tech stocks are not where the action is. Now, this is a fascinating chart to me because what we see here is that the seasonality is churning just like the other big indexes are. This is the Russell 2000. If we break the green line up at the top, I'll switch back to bull. Right now, we're weeks away, 2 weeks away with normal price action from getting back into a bull market. But look at the purple predictor. The purple predictor shows massive buying by the smart money, massive buying. So it looks to me very bullish here that this is going to go up and challenge, and if not break through the old highs. Seasonality here says we should be, you can see we're almost to March, we should be in a seasonally bullish period up until about the third week in April. So I think this scenario is going to hold true here. The yield curve is going to keep a damp down on price action. In other words, we're not going to see a 30% up move this week or this year. I think we'll see a more normal to slightly better than normal movement this year. Now, asset allocation, we talked a lot about this last week. We got a little bit of carry through this week, but a lot of the buying coming into this stock market, this big rally, is from the bond market. It's people selling bonds and buying stocks. And I think it's that massive amount of money which is coming in, which is causing the purple predictor to rally. In other words, the smart money are bond traders going back into stocks. Now, our stock market RISKDICATOR is just chopping at a high level, so there's really no clue here. Global shares, weaker than the U.S., so I prefer to really focus on the U.S. shares. I think that's where the action is. Bonds, I kind of said last week I thought we'd see a short-term rally. We did see that rally, just a couple days. But this market is running out of downside momentum. And I think we're setting up for a nice pop in this market, maybe back up to 122. I would say at least 121, something like that. And that rally in the bonds is going to have a big impact on the stock market. It's going to have a big impact on the gold market and on the dollar. So I'm watching this market extremely closely because this is the one that's really driving everything. Now, I'm not saying that the bear market is over in bonds. I'm not saying that at all. I'm just saying we should see a a decent rally here. Markets don't go down they don't always go in one direction, so look for it to probably rally a little bit here. And I think probably this week is the week that it'll start, get up to 121 to 122, but that rally is going to be a shorting opportunity because the bear market is not over. Now, if bonds are going up, that means, of course, that interest rates are going down. Now, interest rates are the green line there. You can see they're really just staggering around up at the top. We talked a lot about this last week. The gold line is the price of gold, and it's, let's call it sideways. The blue line is probably the most important factor right now, which is the 10-year treasuries in Germany, and it's hooked down. I talked last week about the hook down in the CRB, but it's hooked back up again. So kind of a muddled picture, and that's why bonds are really going sideways, because of this muddled key factors. Now, that's also muddling up the dollar situation. We have a potential double bottom here. It would be confirmed if we break above 90.50, which is that top purple line. And I think really the way to play the dollar is just follow the breakout. If it breaks above 90.50, buy. If it breaks down below that 89.20 level, sell. But while it's inside this range, you really got to stand aside, because this is, unless you're a super short-term trader. Now, notice that gold has the same pattern, same double bottom, double top, I should say. So the same thing. I think with gold, we should just follow the breakout above 1365 or below 1310. Whichever way it goes, I think we put in orders to buy or sell right now. Now, the indicators for gold are a mixed bag as well. The top indicator, which is the euro, you can see it's kind of stable. The middle one is the CRB, kind of bullish, but kind of weakly so. It's the one down at the bottom, the yen, that's really supporting the gold market. But all in all, kind of a mixed bag here. Oil is moving higher. And I think that this movement higher in oil was one of the factors that affected the bond market and will continue, because increasing oil prices is usually what is a leading indicator of inflation. And of course, higher inflation is bearish for bonds. All right, let's talk about Bitcoin. Last week, I put in some trend lines. We broke the first one, and we rallied up to the second one. As I mentioned before, if we break above the highs that we made 4 days ago, I think you've got to get long Bitcoin. And we should be looking for something like a $6,000 rally if we break that. So that would get us up to maybe about 18,000. We'd be challenging the old highs. Other than that strategy, breaking the highs of 4 days ago, I'm going to stand aside here. But if we do break above the highs of 4 days ago, I'm going to go long here. I'm going to want to go long here, looking for probably a $6,000 rally, which is a pretty significant rally. All right, everybody, all you freebies, listen, we're getting more and more people signing up because of all the money that they're making. You should be one of those super cool people. So come on, sign up. It's super cool. You're going to love it. More importantly, I think you're going to make some money. All right, thank you, freebies. Now, fully paid up members, because you are super cool, hang on for just 1 minute.